Welcome in, everyone. I'm joined today here with Nigel Kennett, a chartered professional accountant who helps people think differently about their money and their taxes. And he does a lot of long-term planning as well. Nigel combines his deep technical knowledge with a very human approach to finance, focusing on clarity, intention, and helping his clients understand the bigger picture behind their numbers. And I'm really grateful to have him joining in with us today on some really great topics that we all should lean in on.
Perfect. Thanks, Winnie.
So we're going to have a little mini podcast series based on some topics that I've put together that really matter towards our listeners today who are business owners. They have either small operations or big operations. It really doesn't matter. But I know that you have a lot of experience with that. And I was just wondering if you could speak to that just a tidge.
Yeah, no, I've been in the game for a while, working with small and medium-sized businesses. Had a lot of fun working with entrepreneurs, from startup to looking forward into the future, where they're like, "Oh, okay, like how does this integrate so we can build a long-term plan for my family?" So it's been a really good ride, watching all of my clients grow and develop and prepare themselves and deal with the changing landscape that we constantly find ourselves in.
Indeed. I also work with agricultural operations who quite often, it just comes really naturally to their community to really think long range, and who are also very interested in the infinite banking concept, which I did a high level overview with you in the sense that it is really more of a mindset using a very specific tool, which happens to be a dividend-paying whole life insurance contract. And this is why you are here today, is to help enlighten our listeners a little bit more about how accountants think about these life policies versus how we as business owners typically tend to think, right? And so there's a bit of a gap. But I think more importantly, because the way that we coach our clients is to be okay with exercising the contractual benefits that come along with this contract, which means our clients can take out a policy loan and use it for whatever they would like. It's just a part of the contractual agreement that they have in having this contract. But quite often there's a bit of a mix-up. Well, it gets a little bit foggy in all of our minds because, first of all, I'm not you. Like, I'm not licensed to know all the tax stuff, right? And neither is any of our clients. But because we have to submit for bookkeeping and to file our taxes, quite often the wonderment is, how is it perceived? So as a sole proprietor, how is it different versus how is it different if a corporation borrows money out of a policy?
Yeah, there's a lot to unpack there. And it is really interesting when you talk about the infinite banking concept, because it is a different way of approaching your own finances. And you have this conversation with your clients as well, where you have to kind of tweak how you perceive the infinite banking concept. I got a kick out of the fact when you're talking about long range planning and agriculture. I wasn't sure if that was just like a hidden ranch joke. I don't know. But when we're talking about infinite banking and how it can apply to your finances as an organization, it's just another tool that's in the tool belt that people haven't been utilizing to its fullest capacity. And so when we're talking about policy loans and being able to borrow against that, it just becomes an alternative mode of financing your operations instead of using the traditional mechanisms, which are going to be banks or other registered lending institutions. But this way, if you applied the infinite banking concept, then you can actually use the insurance policies that you've been funding yourself to help finance your organization.
I don't know how much is covered in your continuing education credits, because I know in our industry, we have to have them. In your industry, you have to have them, right? Or how much has actually been taught as you're getting your degree. How much is taught to accountants about cash value permanent policies, like the dividend-paying whole life insurance contract?
Zero. So none of that actually gets addressed in any of the curriculum. That's all veins of accountancy that is usually pursued subsequent to one getting their designation, or if they've had exposure to that at the firm that they've articled at, or where they've received additional training. So like you, yes, we have to maintain a certain number of hours of professional development. And it's because there's so much, like insurance, there's a lot to accountancy and tax. And so there's so many different rabbit holes that you can get caught in. And so learning about insurance and how you can use that to better influence your decision making for your business is really important. when we're talking about entrepreneurs, especially, I think I get a kick out of them because they see a world of opportunity or they can see realms of expansion. Whereas me, like I'm a bean counter that highlights risk and helps support areas of compliance. And so that's one question that I'm faced with regularly is what is Canada Revenue Agency's or CRA's perspective on issue A, issue B, issue C, and all the way down the alphabet. And so it's really interesting when we start tackling these different types of policy loans that you can use for your organization and what CRA's overall view of those is. And it is a changing landscape like anything else. We go through budgetary changes that have different introductions or changes or cancellations. And so it's a thing that I really enjoy about my profession is that it is constantly evolving and constantly changing. And with that, clients are regularly reaching out to me to say, like, how does this impact me? How does this impact my business? How is this going to impact my future?
So say, for example, coming back to the question around they take out a policy loan and they use it to fund a certain aspect of their operations, right? So instead of traditionally using a loan or a line of credit from the bank, let's say they're going to go get feed. And typically, on average, their feed costs around $40,000 a year, right? So they've built up cash values inside their policies enough to, let's say, finance their feed for the year, okay? And so now, instead of the bank owning the debt, like whether it's in a line of credit format or whether or not it's in a loan format, now the loan is now taken over by the individual, okay?
Yep.
But typically, whether it's a loan or a line of credit, there's some paperwork that can be submitted to the bookkeeper or to you, the accountant, to help sort of write it off as an expense. Is that correct?
Yeah, mostly, yeah.
Okay. So I think where it gets a little bit confusing is because most of us individuals, whether you are on a farm or not, we've just always allowed the bank to own the debt. But when we own the debt, it gets a little bit confusing because it's like, okay, so now how do I submit this to my accountant?
Yeah. So when we're talking about arrangements like this, what you've done is you've essentially borrowed against your insurance policy. When we're talking whole life insurance policies where the corporation is the beneficiary, a lot of times we think of that as an expense, right? We're like, oh, okay, this is a negative cash outlay. And so I'm just going to have this recorded as an expense and report it on my income statement. And so if we record it as an expense on the income statement, it drives down the net income of the company. We're talking these whole life insurance policies, the cash surrender value, like that value that you've actually been contributing to the value of your policy, doesn't hit the income statement. It actually hits your balance sheet and gets shown as an asset, something that you own. And so then you're able to then borrow against the cash surrender value of an asset that you have and create a liability. And then it just needs to be a bona fide agreement where you are using the money that has been lended to you by the insurance company to then use for business operations. So there's going to be a subsequent liability that hits the balance sheet as well. And then those transactions are still impacting your cash flow, but it's not hitting the income statement. And so you're borrowing against your life insurance policy. There's going to be insurance on that transaction. And then, not insurance, interest. There's going to be interest on that transaction. But you're paying that loan back. No different than if you went to the bank and you said, hey, dear bank, can you please give me $40,000? And the bank says, oh yeah, we'll give you $40,000, 5% interest, sign here, 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 and here. You sign all the dotted lines and they're like, oh, and sorry, we forgot to mention there's this application processing. You're like, oh, okay. They're like, that's okay. We'll just add it to the line of credit. And then they're like, oh, and then there's this and there's that. And then you're like, oh, okay, well, maybe I should have talked to somebody a bit more mature up the totem pole. But what happens is then you get the cash deposited into your bank account. So you get your $40,000 and then you make regular payments against that. No different than if you got $40,000 from your insurance policy, you get that deposited into your account and then you repay it back. But this way it's self-funded and any interest that's being paid is being paid back to your insurance policy, which is going to increase the value of your insurance policy.
So you were referring to what happens if the policy itself is inside of a corporation, right? If it's owned by a corporation. And so with the you also mentioned a bona fide agreement.
Yeah.
Okay. So who creates this bona fide agreement?
You can shortcut it and you could probably have AI generate loan agreement for you. There's other online tools that are available. I don't want to inadvertently sponsor any, but yeah, like there are online lawyers where they've got these wonderful plug and play options where you can say, oh, I'm completing a loan, and here's the details that'll ask you who's issuing the funding, who's receiving the funding, if there's going to be an interest rate, and things like that.
Okay.
So there's all sorts of tools that are available, but there's key points that you need to cover. One is going to be the value. How much is being borrowed or how much is being lent? And is there an interest rate? It needs to be a legitimate transaction so that there isn't an appearance that we're avoiding anything, right? Sometimes what can happen is that if you have a zero rated loan, for example, there could be a perception that there's a taxable benefit somewhere along the line. And so CRA will be like, hey, like you're issuing funds here and there's no interest. Like, how do we know that this is a legitimate business transaction? So to avoid that perception, you always want to have at least a couple points of interest that are being charged. CRA changes their posted interest rates every quarter. And so they do have values on what loans should be. But yeah, like at least 2 or 3%. And then that's going to cover that. And then there should be a set term of repayment.
A set term of repayment. Okay.
Correct. Yep. And then once that's all covered, you've got yourself like a bona fide agreement that substantiates what the loan's for. This is how you ensure that there's a bona fide agreement for the existence of a loan.
Of course, we know as humans, the longer we wait to create a bona fide agreement, our memory just starts playing tricks on us. So when you do take out a policy loan for business purposes, it's always good to do the bona fide agreement. Of course, the best is beforehand, before the intention is created. And then if you can't do it right before, then do it before you lose track of everything. So sooner is always better.
Scenario. Sometimes and what happens is if there's an absence of information or records, then sometimes us as accountants, we're left in the dark. We don't really know what this transaction is. So if we see a $40,000 deposit, we're thinking, what is this for? Like, where did this come from? And sometimes our experience has been that people will actually just space what happened.
Yeah.
And get caught up in the hustle and bustle of work and life. And especially depending on the different seasons, if we're talking agriculture, if it's calving season, for example, like you're dealing with individuals who are running on limited sleep. And so if we're trying to catch them to explain something and we propose like, well, is this revenue? They're like, oh yeah, that could have been something that I sold. And then we inadvertently record that deposit as revenue when it isn't revenue. And so there's a risk that with the absence of records that you're paying additional tax on transactions that are at non-taxable events. So in a perfect scenario, what's going to happen is like most people don't wake up and they say, I'm pulling money out of my insurance and I'm going to do this, this, and this. Like it's a bit of a process. And even insurance isn't going to be like, oh yeah, it's going to be in your account in the next 20 minutes. There are steps that need to be included to access the funds. And one of those should include developing a loan.
Yes. And thankfully, we do provide, a template that can be used in instances, especially if you're incorporated. This also does, like what we just shared is relevant for holding companies, trusts, and corporations, yeah. I'm assuming?
Corporations, yeah, absolutely. Yeah.
Okay. So what about sole proprietors, like people who are business owners, but they have the policy in their own personal name? And let's say their personal policy is going to lend to the corporation or just even lend money to themselves, but they're operating as a sole proprietor. What's the procedure on that?
So I think we need to cover a few definitions. So one, corporation is its own separate legal entity, right? Pays tax, can own property, holds assets. Individuals are a separate legal entity, right? And so when we're talking about sole proprietorships are businesses that are being operated by an individual and not a corporation. So if an individual has their own life insurance policy, then that insurance policy has been funded with after-tax dollars. So then what happens is when they're filing their personal tax return and they're reporting their business activities, and the accountant sees that there's a deposit that was in the business bank account, then we're kind of running into that same problem addressed earlier where they could be thinking like, well, what is this for? Like, is this revenue? And when we're talking about due dates and deadlines for personal tax filing, personal tax for sole proprietors are due June 15th, but any tax owing is due at the end of April. And so to ensure that the tax is being remit on time, we still see tax practitioners like myself scrambling to give our clients their tax liability so that they're not incurring any interest charges on any tax outstanding. So if we're scrambling and catching people in their busy season when they're seeding or when they're calving or things like that, then there's that risk that deposits to accounts of being recorded as revenue are high. So when we're talking about sole proprietors, we can encounter the same types of issues that a corporation would encounter, where once again, they're just paying tax on deposits that are not revenue.
So despite the fact that one's a corporation and one's a sole proprietorship, obviously the corporation does require that bona fide agreement, but in a sole proprietorship situation, is that still the same sentiment?
Yeah, just because you still want to make sure that you have good records. Good records are always going to be key. If ever CRA wants to investigate and they want to take a look at what these deposits are for, they might assess that as being income erroneously. And then you got to go through all the hassles of challenging their assessments and things like that and
so annoying
notice objections. So it's just a headache that can be avoided by quickly drafting an agreement in advance.
Yes. And let me just tell you, just having personally experienced this myself, like a tax attorney is so expensive. They're like $550, $600, $700 an hour.
Yeah.
So prevention is the key here.
Well, as the old saying goes, an ounce of prevention is worth a pound of cure.
Right. Yeah, exactly. And so, let's bring that analogy back up because it doesn't get said enough, or if it does get said enough, it's like it's highly ignored. So it's time to stop ignoring a really good piece of wisdom.
Busy. Like life is hard and we get caught up in so many different things. Like at the end of the day, I'm a small business owner as well. And I got kids in sports and all sorts of things. And so it's easy for things to get missed, but it's all the more important to take the extra 5, 10, 20 minutes to make sure that something is done correctly than spending time, money, and resources to fix something that could have been set up right at the onset.
I 100% agree. So just because I've been filing for years and years and years, the one curiosity that I've had is when it comes to chart of accounts, that is like a universal language between all Canadian accountants. Is that correct or is that not correct?
So a chart of accounts is one of those wonderful fancy accounting terms that just kind of says where your money is. Right. And so your chart of accounts is usually going to be like a 3-column document where in column A, you've got an account number. In column B, you've got an account description. And then in column C, you have an account type. Right. And so think like if we were to talk about a generic chart of accounts, you might have cash, you'd have maybe a credit card. You'd have your revenue, you'd have advertising expenses or supplies.
So what I'm asking is there a universal code?
The short answer is no. So honestly, in chart of accounts, preference. It really comes down to preference. I've seen chart of accounts, like for example, like my chart of accounts, usually 1,000 accounts are asset accounts, 2,000 accounts are liabilities, 3,000 accounts are going to be like your equity. And then 4,000 accounts are going to be revenues and 5,000 accounts are going to be expenses, right? I've seen other accounts where they've got 100 accounts or assets and 200 accounts or assets and 300 accounts or assets and 400 accounts liabilities.
So if there is no like universal number that can be used for a chart of accountant for Canadians, what do we need to know in the context of what we were talking about today that us as clients can use to speak to accountants about how this should be categorized properly?
And that's going to be that third column. How is this account going to be recorded? Mm-hmm. And so even though cash might be a 1,000, a 100, or 200 account, if we know that this is a cash account, that is going to show up on your balance sheet. If we know that a 400 or 500 account for revenue is a revenue account, then we know it's a revenue account. Think like interest. Sometimes there's so many different types of revenue, right? We could see an account that has a number and a name, and the name could just be interest, right? So, like, okay, interest revenue, or is it an interest expense? Is it an interest expense on long-term debt? And so it's that third column that really helps us ensure that everything's being reported correctly. So that we know that assets are being captured correctly, liabilities are captured correctly, so that your revenues are being...
In the example I used before, if a policy loan is being used for feed, How would that be recorded?
Feed is really, really tricky. And the reason why feed is tricky is because when we're talking about feed for agricultural assets, it can be classified a few different ways. It can be classified as inventory. It can be classified as an expense. So when we're talking about something like that, it really depends. Are they buying feed in advance to use for the next year? Right? So feed is a bit of a wonky one.
What would be a little bit more straightforward? So how about let's talk about a piece of equipment being used. Is that more, I feel like that's more straightforward. So piece of equipment, what would that be categorized for? Like if we take out a policy loan for a piece of equipment?
Yeah. So if you're buying a piece of equipment with a policy loan, then there's economic benefit that comes from that piece of equipment. So we record that as an asset, and then gradually we'll expense it. We'll depreciate it over time. And then we recognize an expense for that piece of equipment over the next 10, 20 years.
And then what about the interest that you're paying back? Because there's a schedule, right? If we're writing out a schedule and the payment. So in terms of the payment, let's say for all intents and purposes, let's say the cost is $100,000 a year. It's $100,000 for the principal payment and then $10,000 for the interest each year.
Yeah. So if they're paying interest and the interest is being paid on a loan that was used specifically for business purposes, such as acquiring equipment or repairs and maintenance to the equipment or anything else that's related to the business, we can expense that interest. And so expensing that interest then reduces your taxable income and reduces your tax liability.
What about the $100,000 payment that's helping to pay back the policy loan?
So the cash that was used to repay the loan, because the loan was recorded initially as a liability, then it's just recorded as a reduction of that liability. So we eventually grind that down to zero. So it doesn't hit the income statement. It just, any payments made towards that loan just reduce the amount of loan. No different than if you had a bank loan and you're making regular payments against your bank loan.
So earlier on, I think there was a client who wrote in and had a question. I think it's sort of similar to this. When I pay back my loans with my policy in the new year, will I be able to borrow more than I did this year for input costs?
It's a good question, because assuming that they've still been contributing towards their whole life insurance policy, then the answer to that should be yes, because then they've got more cash surrender value that they can borrow against.
I love that you've been reading, like Nigel has read the book once over, at least, on becoming your own banker, so he understands. So yes, I will concur with that answer as well. Yeah, and I guess it also just really depends too how many outstanding policy loans you have and if you've also been making regular policy loan repayments. Because this is why Nelson always talked about the fact that you should not steal the peas. You ought to always be in the process of paying yourself back. Because if you want to make sure that you have money there to borrow for the next thing, if you're constantly making policy loan repayments, then there's going to be more for you to borrow than when you first started. So the next question is, I am wondering what CRA's point of view is on whole life policies.
When we're talking about whole life policies, there's the cash surrender value. That's the asset. And then there's kind of that benefit coverage component of it. And then we expense that, right? But when we're talking whole life insurance policies, they're not typically deductible for tax purposes anyway, unless you are required to have an insurance policy as a part of finance, right? So if you needed to have an insurance policy where the bank had first rights to it because you were getting a loan for $1 million to buy quarter sections, then in that case, you could deduct the expense component of it. But otherwise, it gets listed as an asset. And so CRA's general policy towards that is that whole life insurance policies, not deductible for tax, listed as an asset. If it's term insurance, like if it's a 10-year term, and if it's required for financing arrangements, then typically that can be expensed and is deductible for tax purposes.
Because term insurance is like so much more straightforward, but doesn't have any cash value whatsoever. So it's a lot easier to calculate. But from my understanding too, and I did a little bit of digging around this in terms of, yes, if you borrowed like $500,000 from the bank and the bank made it a requirement for you to have insurance in case, you pass away, then is it true that the bank would need to actually produce a letter so that CRA sort of accepts the fact that you are writing off a part of the payment that you're making for the insurance coverage?
Yeah, absolutely. So the bank does a good job of ensuring that all their bases are covered. And so they'll say, yes, like part of the initial offer is that they'll say, like, yeah, like here's our term sheet. And so the term sheet will say, like, yeah, we need to have this, and this. And then you sign all the dotted lines. And one of those documents that is usually that I have never seen not included is that there is that confirmation that the bank will receive the proceeds from you in the catastrophic event of you predeceasing your business.
Yeah.
Fancy way to say die. So they get all your. So like if you got a corporation, you got an insurance policy and you got a loan with the bank and you die, then the bank gets to take the insurance proceeds before anybody else does.
Yeah, no different than if they lend you money on a mortgage and you sell your property and they get paid out first before anyone else does if there's like a balance, you know?
Yeah.
So no different.
In situations like that, absolutely, that's deductible for tax.
Okay. I think we'll just close off on this. I think we've covered a lot of ground just in this one episode. So thank you so much. And luckily we have Nigel in for a series. So until next time.
See you next time, Winnie.
So glad you leaned in with us on the Winnie podcast. We truly hope you're feeling more informed and empowered to take another step towards optimizing your financial life. Right now, make sure you hit subscribe so you can keep growing and learning with us. Until next time, we wish you prosperity in every area of your life.